Hi students, welcome to Sunil's tutorial. I am Sunil Mirwani and today we will be doing capital structure planning. Let's see this. We do illustration 1 on page 198. Now let's see the sum. They have given you that Excel Limited is considering the following financial plans. The key information is as follows. Total investment is 2 lakhs. Plan A, Plan B, Plan C. So first, let's see capital structure. Sources. Now, in all the 3 plans together, you have equity, debt, and preference shares. Okay. Now let's see this Plan A. Percentage rupees. Now they are saying that in Plan A you want 100% equity. The total amount that you need is 2 lakhs. 100% equity means entire 2 lakhs is going to come from here, right? Plan B. Percentage rupees. Plan B is equity is 50% and debt is 50%. Total amount required is 2 lakhs. So in that case this is going to be 1 lakh and this is going to be 1 lakh. Plan C. Percentage and rupees. Plan C says that 50% is equity and 50% is preference shares. Total amount required is 2 lakhs. So this is going to be 1 lakh here and 1 lakh here. Right? So these are the 3 different plans. Now face value FV of each share. They have given you that the face value of each share. They are saying that equity shares of rupees 10 each, but they are issued at a premium of 10 each. So they have given you the issue price in this case. Shares are being issued at 20 rupees each, right? So in that case, if shares are being issued at 20 rupees each, what will be the number of shares? Number of shares is equity share capital divided by issue price. So 2 lakhs divided by 20. So that is going to be 10 less 1, 2, 3, 4, 10,000 shares. This is 1 lakh divided by 20, that is 5,000 shares, and again 1 lakh divided by 20, 5,000 shares. So the first thing that you need to make is the capital structure. Once your capital structure is ready, then the next thing that you need to find out is EPS. Calculation of EPS. EBIT, make the structure first. EBIT less interest will give you EBT, less tax will give you EAT, less preference dividend will give you amount available to the shareholders, equity shareholders, divided by the number of shares will give you EPS. You have Plan A, Plan B and Plan C. Now let's see. Adjustment number F says that EBIT is 80,000. So in all the cases EBIT is 80,000. Right? Interest. In Plan A there is no debt, so there will be no interest. In Plan B debt is 1 lakh rupees and the interest rate, cost of debt is given to you in adjustment number C. Cost of debt is given to you as 8%. So 8% on 1 lakh is going to be 8,000. Plan C again has no debt. So you will get EBT as 80,000, 72,000 and 80,000. Tax rate is given to you as 50%. So this is going to be 40,000, 36,000 and 40,000. Hence your EAT is going to be 40,000, 36,000 and 40,000. Preference dividend. Plan A has no preference shares. Plan B has no preference shares. Plan C has preference share capital of 1 lakh and the cost of preference shares is given to you as 8%. So 8,000. Thus the amount available is 40,000, 36,000 and 32,000. Number of shares we have already found out in capital structure, that is 1,500, no 10,000, sorry, 10,000, 5,000 and 5,000. So your EPS is going to be 4 rupees per share, 36, 7.2, 6.4, right? So this is going to be your earning per share. So from an investor's perspective, the maximum earning per share is on plan B, as EPS is maximum in plan B. Therefore, plan B should be selected. This is if you go as per EPS. Now, let us find out calculation as per calculation of break-even point. What is break-even point, people? It is a point of no profit, no loss. When the business is in a no profit, no loss situation, then that is called as a break-even point. So let's make the table first. EBIT less interest gives you EBT, less tax gives you EAT, less preference dividend gives you amount available to the equity shareholders, divided by number of shares will give you EPS. Plan A, Plan B, Plan C. Now, when you are calculating break-even point, you have to assume EAT to be nil. To find out the break-even point, you have to work back, people. You start from the answer and you move to the question. So you assume the EAT to be nil. Sorry. You assume the amount available to equity shareholders as nil. You will assume the amount available to equity shareholders as nil. Right? Now, preference dividend. Plan A has no preference share capital. Plan B has no preference share capital. Plan C has preference share capital of 1 lakh and the cost of preference shares is 8%. So this is going to be 8,000. Therefore, nil. EAT will be nil here. EAT will be nil here. We know that 8,000 minus 8,000 will give you nil. Hence, your EAT for plan C will be 8,000. Tax rate is given to you as 50%. If tax is 50%, then EAT will also be 50%. Simply it means that whatever is your EAT, tax will also be the same thing. So if EAT is nil, tax will be nil, nil and 8,000. EAT and tax rate will be same because tax rate is given to you as 50%. So in that case, this will be nil, nil, and this has to be 16,000 because 16,000 minus 8,000 will give you 8,000. Plan 1 has no debt, so interest will be nil. Plan 2 or Plan B has a debt of 1 lakh and the cost of debt is 8%, so interest will be 8,000. And Plan C has no debt. So in that case, EBIT is nil. This has to be 8,000 and this has to be 16,000. Since the EBIT of Plan A is minimum, therefore it will be very easy for the businessman to achieve break-even point in Plan A. Hence, Plan A should be selected. Conclusion: since EBIT of plan A is minimum, therefore plan A should be selected. Now, as per EPS, plan B should be selected. As per break-even point, plan A should be selected. How do I decide what plan should be selected? For which, what we do is we go in for indifference analysis. What is indifference analysis? It is an analysis wherein at any given point, both the plans will give you equal benefit. I have to make the plan indifferent, both for the investor and for the owner. Right? Let's do indifference analysis. I have to do, since as per EPS plan B was selected and as per break-even point plan A was selected, I am going to do an indifference between plan A and plan B. Right? Let's see, EBIT less interest gives you EBT, less tax gives you EAT, less preference dividend gives you amount available, divided by number of shares gives you EPS. Right? Now when you are doing indifference analysis, you have to assume EBIT to be X. For indifference analysis, you assume EBIT to be X. Now interest. In plan A there is no debt, so interest will be nil. In plan B you have a debt of 1 lakh rupees, on which cost of debt is 8%, so this is going to be 8,000. Hence your EBIT is going to be X and X minus 8,000. Tax rate is given to you as 50%. 50% means 50 upon 100. 50 upon 100 is nothing but 1 upon 2. So this is going to be 1 upon 2x. This is going to be like 1 upon 2x, and this is 1 upon 2 into x minus 8,000. Now, EAT. EBT minus tax will give you EAT. Since tax is 50%, that means your EAT also should be 50%. So this will be 1 upon 2x and this will be 1 upon 2x minus 8,000. Preference dividend. Neither plan A has a preference share capital nor plan B has preference share capital. Therefore, the amount available will be 1 upon 2x and this is going to be 1 upon 2x minus 8,000. Number of shares. Plan A has 10,000 shares and plan B has 5,000 shares. Therefore, your EPS will be 1 upon 2x divided by 10,000, and here this will be 1 upon 2x minus 8,000 divided by 5,000. Right? Now, for indifference analysis, you have to assume the EPS of A to be equal to the EPS of B. EPS of A is assumed to be equal to EPS of B. It's only if the EPS of both the companies are same will you be indifferent to both the companies. That means 1 upon 2x divided by 10,000 should be equal to 1 upon 2x minus 8,000 divided by 5,000. 0, 0, 0. 3 zeros and 3 zeros gets cancelled. 5 ones are, 5 twos are. Half and half gets cancelled. So you will get x, this 2 which is here, okay, we will write this here. X upon 2 is x minus 8,000. X is equal to 2x minus 16,000. Cross multiply. Therefore, you will get 16,000 is 2x minus x. So, x is equal to 8,000. That means if the company achieves an EBIT of 8,000, both plan A and plan B will give you the same EPS. Thus, the company will be, or the investor as well as the owner, both of them will be indifferent if an EBIT of 8,000 is achieved. This finishes the sum. We will stop here for the day. Thank you very much.